Chicago investment advisory firms are scrambling to find their place in the industry's acquire or be acquired landscape, and one is determined to be a survivor. RMB Capital, which has become the second largest independent advisory firm in the state, absorbed 3 firms last year, nearly doubling its assets under management, and extending its geographic reach. This year, the 200-employee firm is adding space at its Chicago headquarters after opening a Minneapolis outpost in March, and it has plans to open a street Joseph Mish office this year. The industry consensus is definitely that there's going to continue to be an acceleration of consolidation, says RMB CEO Richard Borage Jr., for whom the 13-year-old firm is named. After accumulating $9.1 billion in assets, privately held RMB ranks behind just Browns and Ramus. They'll both be forced to keep up aggressive growth strategies if they expect to compete against each other, expanding national peers and larger, broader-based financial institutions. Borage, 56, is that rare CEO who's been at the helm since the firm's founding, when he partnered with Frederick Paulman to launch it in 2005. He'd been in the industry for a couple of decades, gaining experience at UBS Financial Services, Bear Stearns, LF, Rothschild and Lehman Bros before taking the risk of starting his own shop. A knock for the work may have been in his blood. His father, Richard Borage Sr., had an illustrious career in the field, working for 17 years for Chicago's top money manager, Northern Trust, and separately as a treasurer and manager overseeing the well-to-do University of Chicago endowment. The senior Borage, 89, I wasn't involved in starting RMB, but he was part of it from the start and still reports to work daily, sharing his book of business with younger partners. Launching the business a few years before the 2008 financial crisis dragged down financial markets worldwide may not have been the best timing, but at least it gave Borage time to lay the foundation as the downturn spurred major shifts in the industry, including an exodus of investment managers from big banks cutting their ranks. Driving the consolidation is a shift from active investing to passive index-linked investments, aging advisory firm leadership surprisingly short on succession plans, and the desire of remaining partners to be part of a larger entity, says Chip Rome, managing partner at industry consultant Tiburon Strategic Advisors and Tiburon, Caliph. There's also some sense of defensiveness, with some sellers thinking one must be bigger to survive, he says by email. The value of merger and acquisition activity in the U.S. fell 20% last year to $1.4 trillion, even though the number of deals increased, and there were even bigger declines in the value of deals in the U.S. finance sector and the Midwest region. But the value of deals in the middle market finance sector surged 30% to $28 billion for nearly 100 transactions, according to research firm Dealogic. The value and number of deals in that middle market category, between $100 million and $1 billion, rose in each of the past 2 years. Borage says prices for acquisition targets are climbing, too. RMB didn't disclose financial details of its recent transactions, but it's likely they're in that middle market range. Last year, RMB bought Milwaukee-based Jacobus Wealth Management in October, Oakbrook Terrace-based Ironbridge Capital Management in June and Lake Forest-based Benwell in May. Borage says he prefers organic growth, and, indeed, the company has hired 70 employees since June 30, 2016, when its assets were just $5.2 billion. While RMB mainly caters to wealthy individuals and families with a variety of financial services, including retirement and estate planning, insurance analysis and charitable giving, it also serves less affluent customers as well as institutional and corporate clients. In addition, a related unit manages a suite of RMB mutual funds for firm clients and outsiders. Others on the move. Other Chicago firms haven't been standing still. say Galbraith. When firms start to reduce in size, it becomes treacherous, says Galbraith CEO Philip Hildebrandt, in noting that compliance, research and regulatory costs have risen significantly in recent years. Another Chicago company, Hightower, has had a strategy since its 2007 inception revolving around poaching wealth management businesses from large New York-based financial firms. Mesirow Financial and Baird, which offer a wider array of services beyond just investment management, have also made acquisitions in recent years. On the flip side, some local firms have been snapped up by rivals. Toronto-based CIBC paid $135 million last year to buy Geneva Advisors, which has about $8.5 billion in assets. Borage, still the firm's majority owner though increasingly rewarding junior partners with equity, says he receives calls from larger firms interested in buying RMB, but puts them off with an unequivocal aim to remain independent. If prices keep rising, the industry's consolidation will test his resolve.